profitability ratios. So these ratios measure how efficiently the firm uses its assets and how efficiently the firm manages its operations. Here I want to show you three important ratios. These ratios are very important, very useful for shareholders and investors. The first one is profit margin. It's net income divided by sales. Where you can get net income and sales, both are available in your income statement. As you can see here, for income statement, actually, as you remember, as we discussed before, you start with sales and then you reach to net income. So we divide net income and that is by sales. So 363 divided by 2,311 will give you 15.7%. And for these type of ratios, of course, we prefer higher. And for this case means for $1 in sales, this company can make 15.7 cents in net income. Another one is return on assets, means how efficiently this firm can use its assets to generate net income. So we divide net income by total assets. Net income is available in income statement and total assets is available in balance sheet. And for this firm, we got $363 divided by $3,588, 10.12%. This means that for $1 in total assets, this company can generate 10.12 cents in net income. And you may be interested to know how efficiently the firm can use its shareholders' equity in generating net income. In this case, we deduct the debt from the denominator and we get net income divided by total equity. Net income is again in income statement and total equity is in balance sheet. 363 divided by 2,591 means 14.01%. Means for $1 in shareholders' equity, this company, for every $1 in shareholders' equity, this company can generate 14.01 cent net income.